Good morning, everyone. I hope you had a nice, long Memorial Day weekend. I wanted to talk about how I prepare for the week, what I do the morning of the first day of the week, and what I'm doing to kind of get my head right and find what kind of edge we might be able to find in the market. First thing, I wanted to point out the weekly chart. If we're trading the 5-minute chart or the hourly or the tick chart, some lower time frame, it's really nice to know the larger time frame biases. And even if you're trading like a daily chart, then you want to look at the monthly chart, and just you want to know what's going on the bigger picture, and that's going to give you evidence of where a slight bias might be. Looking at this weekly chart, if I zoom way out, I mean the farther I zoom out, the more and more we're going to see that we're in a bull trend. So I could load more bars on here, and you could see further on that the market's been going up for a long time. But then as we zoom more in, okay, we were in a fairly strong bull channel here, and we had this sharp breakout below that bull channel. Now we've had sort of a V-shaped recovery to come back up near these highs and pulling back near this channel. Let me draw this channel in. A lot of channels are visual, right? I can tell there's a channel there. I don't necessarily need to draw it in. But with drawing this in, we can see that we're getting close back up to the low of that channel. We're getting close to where this bear sell-off started. And anytime I see a sharp sell-off like this, or maybe like this or this, I'm looking at where was the first opening price of that sell-off, and that would be right here. And often you'll see this opening price act as a target and as resistance. So as the market's going back up, it'll see the opening price and say, wow, the selling really started strongly there. There's probably a lot of orders there. There's going to be a lot of focus on that price. So it acts as a target as the market's moving back up towards it. Once it gets there, it often acts as resistance. So even if the market just blows right through it and it continues higher, there's usually, with this being a weekly chart, I would expect at least a couple days of a pullback happening around that price. So even if it just breaks up and keeps on in a bull trend, usually there's some reaction to the price where this strong bear sell-off starts. And just like if the market started pulling back here, I would look at the start of this bull rally. I would look at the open. So this is an important opening price here. So I would expect there to be reaction if the market pulled back here. Last few weeks, we're starting to get a bit of a wedge pattern. So first push up, pull back, second push, pull back, third push. So I can draw that in. So some kind of wedge here. Now, we're getting some sort of wedge pattern, but we've not gotten a setup that would lead me to believe that the market is likely to sell off quickly here. Okay, so yes, wedge pattern, which is a reversal pattern, but we've not had a setup form or trigger yet. Right? We got a bear bar here, but we haven't gone below it yet. This bear bar, it's not quite an inside bar. It's almost an inside bar. And an inside bar being a bar that's inside the previous bar. It's like this bear bar. This is an inside bar. It is inside of the previous bar here. This is almost an inside bar. It at least has a lot of overlap. So we went up here, and then we went down here, and then it had tails on the tops and bottoms. So there's a lot of overlap, a lot of sideways around this area. So with inside bars like this, an inside bar is a drop in volatility. Right, so the market's moving big, and then you get a inside bar, and it stays within that prior range. That means your volatility has dropped. Whenever you have a drop in volatility, you often get a spike in volatility. Right, so if volatility has contracted, then usually pretty soon you'll get a expansion in volatility. You can see that here. 4 bear bars down, then we went sideways a little bit, So we contracted, you got this inside bar, and then the market kept on going down, and then that volatility expanded. And right, volatility is always kind of doing this. If the volatility is really big, you can assume that at some point soon that volatility will likely come back in. And if it's already like this, then you can expect that to break out. Kind of like what we were talking about when the VIX got above 35, and the VIX tracks volatility. When the VIX got above 35 here, we put on a bullish position, so we bought during this sell-off. And one reason to buy is because of the relationship with volatility and price. Typically, if you see high volatility, that means the market is going down sharply. Because the market goes down quicker, it goes down quicker than it goes up. So if the volatility is very high and we expect volatility to contract, well, a lower volatility market usually is going up. This is a lower volatility market. It's where it just kind of trickles up. Most of the days are bullish, and we get some little pullbacks. This is a lower volatility environment. This is a higher volatility environment. So volatility is really high here, and it usually contracts. So that contraction is a lower volatility. Lower volatility usually means more bullish. Okay, so we had taken that bullish position here. And the point I wanted to make with this is that we went sideways here on this bar. We might go sideways another week or two right in this area. And by the way, this is the week. We are on a weekly chart, by the way. So each bar here is a weekly bar. So we had a big bull bar here. Now we've gone sideways. We could continue to go sideways for a week or two more, and if we do, I would expect there to be a breakout of that, and then either breakout up or down, kind of like how we had here. We went sideways for a few weeks, then we broke out to the downside. Or it might just go ahead and happen this week. So this alone might be enough to be like that drop in volatility, and then basically when you get inside bars like this, the market wants to break out of that. Okay, so it broke out here, sideways here, went the wrong direction, and then quickly shot back up. So after we've had this bull rally, I'm expecting some kind of movement outside of this range. Is it going to be in a couple weeks from now when we go sideways a couple weeks, or is it going to be this week? Well, I would expect this week to at least test either the low of the prior week or the high, and it might test both. What am I leaning towards right now? I'm leaning towards it wanting to test the high of this bar. So I think we still have some targets above the market wants to test. I think the high of this sell-off, so the opening price of the sell-off around close to 6,200, and I think the top of this bar, it at least wants to test. I think this week at least wants to test the top of this bar, and it might want to test the low as well. Both of these are important prices. So what I would expect from this week is if we today's Tuesday, so let's say Tuesday is a really bullish day and we get up here, it might keep on heading up, but if it fails around the high of last week, then my next target would be the low of last week, so down here. So I would kind of expect this to be able to play off of this range. So let's say we go down and we test the low of last week. It might break down lower, which I'm kind of expecting some kind of breakout to happen. But if that breakout fails, then I would expect it to want to test the other side. So there's two things that might happen. We might get a breakout, but if that breakout fails, then the other side of this range is important. So I expect it to try to test at least one of them, and it either breaks out from there or it pulls back into the range and ends up as a failed breakout. So look for a failed breakout of the high of this bar or the low of this bar. So the high or low of last week. So let's go down to the daily chart and we'll continue to zoom in. One thing I want to point out is I had that measured move on here for at least a few weeks now. So measure move from the open of this bull bar to the close of this bull bar. It's the biggest bar on the chart. It's the most significant thing that happened here. So measure move of this big breakout bar, that puts us up here. And we've tested that measure move point. So the market had a target, and it was able to hit that target. Now my thoughts were that target was also so close to 6,000 that I thought we would get to 6,000 here, and we still might. I just thought it would get to it initially on this first time. So instead of there being able to buy it up to 6,000 and sell 6,000, there were sellers that front ran that trade. So instead of selling higher, they said, we're going to sell here, and if it goes higher, we'll probably just sell more higher, so we'll go ahead and sell early. So they sold here. They were betting against the test of the 6,000. One pattern I'm seeing here is a spike and channel trend. So what is the spike? Maybe this is the spike. That'd probably be the best case. So spike here and then channel up. You could also look at it as this being the spike. So spike and then channel. Now effectively, I think that this is the spike, but it kind of looks cleaner if I do it like, if I draw the channel from here, I think. And well, either way, so somewhere here, this is the spike part of the pattern, and then here is the channel. So spike, channel. What happens after channel? 75% of the time, it transitions into a trading range. 25% of the time, it breaks out above the top of the channel and heads up higher. So most of the time, we could expect this to transition into a trading range at some point. So if it breaks below the channel, probably the low of the trading range would be somewhere down here. So let's say it breaks below the channel, maybe tries to test back up, then I would expect the low of the trading range to be right down here. And then we would kind of play around in this area something like that. If you break out above it, might as well draw that in too. Let's say the market breaks above it, above like this. 75% of the time, the market pulls back into the channel and then ends up as a trading range. So 75% of the time would probably do something like that. Okay, so one of these outcomes, this is the most likely outcome. It would be less common for it to break out here and then head up stronger. So I'm talking about there being a trading range, but until that trading range really starts to form, I think you should still try to be focused on staying in the direction of the trend. So yes, we'll probably have a trading range at some point here. We could have a larger trading range down near these lows, or the trading range could be to here, or maybe to this low. And probably sellers above this will be able to make money. But it's easier to just try to stay focused on the direction of the trend. And what is the direction? Well, we have this channel pointing up. We have the moving average that's pointed up. We have the 200 moving average that we're now above. We have gaps that are open. We have a gap here. And we have a gap here that we've not fully been able to pull back and test yet. In a previous video I had made, I talked about how gaps normally fill. One way you can get in trouble though is when you have gaps on the upside. These gaps might never fill. So when we see these gaps on the downside, like a gap here and a gap here, notice how the market pulled back and it closed those gaps because the market has a slight bias to the upside. And the trouble is when you get gaps when the market's moving up like this, probably it will come back here and close this. But it's more likely, there's a higher chance that like this gap won't fill than one of these gaps. Let's say this does end up as a V-shaped recovery. The market shot down, now it's shooting up, and it breaks above our previous highs and it goes up to 7,000. Well, if we end up as a new bull trend here, and then imagine a future pullback of 20% and the market's around like 7,500 or 8,000, that 20% pullback 3 years from now might not be enough to get back down to this gap. And the market may never come back and test this. Now, I'm not saying I'm that optimistic. I think it will test it. But I've seen from previous examples, like the COVID lows, that was what got a lot of people in trouble. They saw um, they saw reasons to sell. They saw these gaps, and they say, oh well, the gap will probably fill. Usually, gaps on the daily chart fill. But then the market never came back. Right? The market has not come back to 3,000. It probably never will. So people that were selling to try to close those gaps, they got stuck and they got trapped into a bad trade. So I just wanted to point that out about those gaps. To me, these gaps are a sign of strength. I would not try to be trying to be selling to close these gaps. Now these gaps, like this gap here and this gap, any gaps that you have on the way down, I think those are gaps that very strong chance those will close, and it's okay to try to buy small and almost trade it treat it like more of a long-term trade, like a yearly trade, where you might buy here, and if the market pulls back to 4,000, 3,000, then you can buy more and treat it like an investment in a way. But it's different on the way up. You don't want to be trying to sell into this. This can really get you in trouble. And once you've traded through a handful of crashes, then you kind of start to get the feel of yes, it's better to buy on the way down than it is to try to sell on the way up. So we're above the moving averages. We pulled back here and we bottomed right at these right where the convergence of the two moving averages is happening. And that's right where we bottomed at. So if I was trading in the daily chart like this, I would maintain my bullishness. Even if the market might do something, it comes back below this low or this low or this low. It might do that, but the edge is still bullish. All right, we had this large bear trap. Markets in a channel here. Markets above the moving average. We're getting gaps, right? That's bullish. So if I was doing anything, I'd be buying. I would try to avoid selling. Not saying on a lower time frame you can find shorts, but if I'm looking at this daily chart, I would only be buying. I would not try to be finding ways to get short. I would need more for me to get short. But this alone, this is enough for me to buy with a small position and just hold it. If the market goes down, I would hold on to it, or the market goes up, and I would take profits on the way up. So this is enough for me to buy somewhere, trade small, treat it like a longer term trade, but it's not enough for me to sell. Okay, so what I'm seeing here is a bias to the upside. Now coming off of the 3-day weekend, I thought I was going to be curious where we opened up. There's a few different pieces of news that came out of the weekend, and it was interesting to see how the market would react. There's always kind of a weird feeling going into a 3-day weekend because there's that extra day, and the market. The futures are open, so people can still trade, but there's not really any volume to trade. So don't trade holidays because there's low volume. The charts are weird. So avoid trading on holidays. But coming back from a 3-day weekend, it's always interesting to see where the chart ends up. So as we continue to zoom in, my premise is bullish, and this is the Monday, the Memorial Day. Market gapped up and actually had a little bit of a bullish day yesterday. So the start of the week has been bullish. What I would look for on like other days this week, I'm seeing we're in a bull trend. We've had a pullback to the moving average. And then we've had a couple bullish days. If the market's going to go higher, an early low of the day, let's say today is a bull day. When did the low of that day occur? Well, if the day is a bullish day, the low happened somewhere early in the day, probably in the first couple hours. All right, the market didn't go up all day and then have a big move down and have a late low of the day and then go back up. No, I mean if we're in a bull trend, the low of the day happens early. Like we can see, I mean, look at all these bull days. When you see these bull days, the tails on the bottom, those tails happened early. Just like over here, when the market's moving down, these little tails on the tops of these bear bars, these happened early. So traders, when they see a direction on a higher time frame, you can try to catch an early low of the day when you're trading like your 5-minute chart. So when I'm seeing this, I'm seeing a bullish bias. I would be more inclined to try to take some sort of swing buy early in the day and try to bet that today would be a bullish day. So when I see the market doing this or doing this, then I'm more inclined to try to look for that early low or high of the day. And one question that comes up a lot is okay, I want to learn how to trade. I enjoy trading, but I trade a 9 to 5. How am I supposed to? What can I do to still trade while having this full-time job? Well, one way, I mean, if it still works out with your schedule, is you could take a swing trade early in the day, and then basically you can hold that throughout the day. So let me look at an example. Like we were talking about how the market has been bullish, so we want to look for an early low of the day. Here's one example. This isn't really the best example, but big gap down. We're in a bullish market. 2 bull bars in a row. Well, you buy above that bull bar, put the stop below, and then go for 2 times your risk or more. And doing that's going to be something like up here. So you sell around yesterday's close. And so you bought here, then you went to work, and you came back around your lunchtime, and you say, oh, I took a profit way up here. Another example, I mean, this is the same kind of setup, same idea. So buying here, trying to get out somewhere, 2 times your risk, grab the close. Another example, once again, we're in a bullish market. Here's a double bottom early on the open. You try to buy here and try to get it to swing trade up. In this case, you would have been stopped out, and you're not going to be perfect. But then if you had done like this buy, so double bottom here and then bought above here, then that would have worked out. So you're going to have some losses, but some of your wins are going to be very large. And so that's how you can basically take one trade early in the morning and then be able to go to work or be able to do something else. And that really is not a bad way to trade. I mean, really, it gives you lots of time. And I mean, really, they're pretty good trade setups as well. So when the higher time frame is trending, then look for early low or highs of the day. So whenever I see the market, we get it back above the moving average like this, then we're having bull days, higher lows, higher highs, then that's kind of something that my mind would switch to, is to try to look for those kinds of entries. As I zoom in further, we're now on the 5-minute chart here. And so this is yesterday's Memorial Day. So you can see it's clearly a smaller range. The volume's smaller. It's just not as, just avoid the holidays. Go do something else. But once I get down to the 5-minute chart, I like to find my overnight highs and lows. So that's what I've done. I've plotted what was the lowest lowest point from overnight, and what was the highest point from overnight. Put those on, because those can act as important support and resistance. They can act as reversal points. So often you'll see the market it'll come down and test this overnight low. Maybe it'll break through a little bit, but then it'll fail, and then it'll end up reversing up and going higher. And so, well, there might be potential swing trade from that, or the same thing on the way up. They could act as targets, or they could act as support and resistance. So it's always nice to have these overnight highs and lows on your chart. Another thing I wanted to point out, when I go back to the weekly chart, we're getting pretty close to last week's open. So the market opened here. So I want to have that on the chart as well. I want to have this open, and it'd be okay to have like the close of last week on as well, and the low of last week and the high of last week. So those are all good to have on. What's closest right now is the open of last week. And so I already checked it out. It's basically where the overnight high is. So so this line kind of counts as two different points of support and resistance. So what we've done, we've started with a higher time frame. We've found the biases, we found what the chart's doing, and we've zoomed in, and we build on top of what our ideas are. And then we get to our final chart, the chart that we'll actually trade, and we do our overnight highs and lows, and then we double check that we have the support and resistances that we want. So that's how I prepare the chart, how I prepare my mind for what kind of biases there might be going into this week. And the last thing that is really not optional, this is something you need to be doing. You need to be logging your trades and documenting them. And so you can see here, I always have spreadsheets of my trades. So these are some, not necessarily trades that I took. I kind of always keep like catalogs of the different kind of setups I see. So the different categories of setups, I log those, and I look at it and I say, what's working? Because typically what's working will continue to work, and what's not working will continue to not work until the market does something different, and then it'll have a different period of time where that different set of setups will work. So I'm always kind of logging the different trade ideas that I have. Whether I take them or not, I just want to log like how is this type of setup performing? And if I say, yeah, the last couple days this has been doing well, it'll probably continue to be like that for a little bit, a couple days or more. Or if something's been doing well for like a couple months, I could probably get at least a few days out of that or a few weeks out of it. And then as it switches and does something different, I'm continuing to keep track of that. And then I can look at that change and I say, on average, like this trade's been doing better recently. So we're kind of coming into a different type of market. So that keeps you on your toes. It keeps you ahead of the game. So if you're not documenting your trades like that and then reviewing them and really kind of getting into the numbers and being able to find your like expected value of that trade, I mean that's what you need to be doing. That's really not optional. You can do everything else, and if you're not documenting your trades and trying to figure out the math behind the trades, if you're not doing that, everything else probably won't even matter. So make sure you're logging your trades and keeping track of what is working. So if you liked this video, go ahead and subscribe. I put out content like this often. Sometimes it's sporadic, and so you don't want to miss it. So if you're subscribed, it'll be shown to you. Also, I'm going to put a video on here that I just recently made. It is 3 tips to improve your trading, and I think that's a really good video. So consider checking that out. I think it's it's 3 very actionable tips on how you can improve your trading, like starting today, like what you can go in and what you can focus on today. So I think that's a really good video, and that's why I made the video, right? Because I think it's really valuable. So I'll put that at the end here, and consider checking that out. Thank you guys for watching. I hope you have a good trading week, and I'll see you next time in one of the videos I make probably today. All right, see you guys.